Hey, everybody. According to Boston College, we haven't learned anything. We struggled, we being retirees and people heading towards retirement. Apparently, we don't know how to handle inflation in our portfolio. So, I want to make sure that we learn some lessons from this last blip of inflation. And I call it a blip. It had a nice little spike, and that's all we've seen so far. I think it's possible we see some more in the future. I think that's an easy bet. So, let's make sure we understand how our portfolio needs to be structured so we can handle the next time we have inflationary periods. All right. So the first thing we need to understand is what we did wrong. Okay. And the easiest way to do this is to look at charts like this. This shows inflation and interest rates. You look all the way back to the 70s and early 80s, late 70s, early 80s. That was the last time we saw huge inflation. Okay, the purple line, the dark line, is the inflation line. You see the spikes of inflation and the reaction of interest rates being pushed up. So when we see inflation, the Feds push interest rates up. That's their tool to squash inflation. They've done it over and over and over and over again. Now, sometimes we pushed interest rates down and started pushing them up, and we saw inflation, it caused some problems, and then we end up pushing interest rates back down. So sometimes it's the tail wagging the dog, sometimes it's the dog wagging the tail. So we have to be careful about this. So you look through this chart and you start understanding that correlation, but I want you to understand that the vast majority of us and our financial life experience has been after inflation went away. It was pretty benign and normal. It was 2, 3, 4% for several decades. Okay. But interest rates just kept coming down and down and down. So you look at the inflation line, the purple line, and the mean line is going to be pretty flat. Whereas the interest rate line, you're going to be able to ski on that. Okay. So now when interest rates hit zero, investments like bonds are not going to do well. And that's why you see in many of my videos talking about bonds that you look at any 15-year, 20-year track record of any bond fund out there, and you're going to see little to no returns. And that's before the fees that your advisor is charging you to pick these funds. It's obvious as interest rates rise, the value of a bond goes down. So if we hit zero interest rates, we shouldn't be in bonds. And then we understand the correlation of inflation. You see the little spike we just experienced right here. The purple line that goes all the way up, the high it hit was about 9% in inflation. And look at the tiny little adjustment we made to interest rates that felt like we just rocketed interest rates. Let's keep this into perspective, right? We got to keep this into perspective because our interest rates really aren't that high. In the history of interest rates, our interest rates aren't high, and we started seeing some banks falter. We're seeing the housing market pretty stagnant. We're all surprised the house market hasn't come down and caused us to lower interest rates. So it's very difficult for us to raise interest rates, but the Feds have proven that they will continue to push interest rates up if we see inflation. Now, they jumped the interest rates, inflation calmed down a little bit. They're not going to raise interest rates unless we see more inflation. Well, look at the last time we saw any significant inflation, and you'll notice we have multiple fits of inflation. So, is there more to come? Maybe. So what do we got to do in our portfolios to make sure we're prepared for this? I've seen plenty of people come to me asking, how do I fix this problem? I was in bonds. I had 40, 50% of my portfolio in bonds, and it's down still 10%. How do I fix this problem? Well, one, you shouldn't have been in bonds. You should have an advisor that actually understands investing. There's no advisor out there that understands investing that thinks that you should have been in bonds after interest rates went to zero. It made no sense whatsoever. So let's talk about how we do this. The first thing I want to explain to you is having a proper allocation to the stock market. This chart is so cool because all those blue lines are the stock market and the little orange dots are the inflation. And so you can see the vast majority of the time, the stock market outperforms inflation, except in all these little bad years you see here. The big one is the 2008 crash right there. And we know that, the pandemic, I mean, it rocketed down, but it rocketed straight back up. So in a year, it didn't really look that bad. So we look at stuff like this and say, well, look, I know plenty of people that head off into retirement and lose their taste for the stock market. I get it. Okay. But over time, the stock market has done a very good job at helping us keep up with inflation. So now when I talk about a proper allocation, we do have to take your emotions into account. You have to go enjoy your retirement, or, you have to be able to retire. So everybody's going to have a different allocation. There's no chart that says this is how much you should have because you're this old. That is the most ridiculous part of our industry, is overgeneralizing. We can't overgeneralize. So a proper allocation to the stock market, okay, allows you to never have to withdraw from losses. That's the first thing. The cardinal sin of a retirement portfolio is exposing your need to withdraw money from a down portfolio. This means you have to have some safe investments in the part of the portfolio you're going to pull from. For instance, some people head off into retirement, and the only time they pull money out of their portfolio is because they have a required minimum distribution from their IRA. They really don't have a huge need for any of the rest of their money. So the only place that they're going to need some safe investments is in their IRA. You shove some safe investments in there. When the stock market's not doing well, you pull from those safe investments. It's that simple. So this is a necessity standpoint. Do you need your money at all? And how much of your money do you need? Let's make sure we have a contingency plan for when the market's not doing well, so we can pull from some place that did not lose a penny. Very important. Big flaw number one, bonds can lose money. If interest rates rise, your bond portfolio is down, do not pull from that portfolio, which means you have to have different safe investments than just bonds. You want to integrate some bonds in there? Great, I don't have a problem with that. We'll talk about that. But the reality is you can't just have stocks and just have bonds. I've been screaming this for 20 years. This is ridiculousness. We've had very low to no interest rates for 20 years. We should not be using bonds as our only safe investment. That has been ridiculous for 20 years. We knew 2022 was coming. We knew interest rates were going to rise and the stock market was going to fall at some point. But the performance you've had in these bond portfolios for the last 20 years has been limited to nothing, and you're better choices out there. Okay, so the first thing you have to do when it comes to a proper allocation to the stock market is make sure you have the ability to pull from somewhere that has not lost money. The next part, never panic sell, meaning this is the emotional side. This is the emotional side. You need to be able to sleep at night. If the market's down 40%, you're not losing sleep, because you know that the only part of your portfolio that's in the stock market, you don't need to survive. It is just turbulence if you're not withdrawing the money. It is just turbulence if you're not withdrawing the money. Now, if you go out there and go buy an individual stock and that stock goes to zero, that's losses. But if the market as a whole, if you own the S&P 500 fund and the market as a whole goes down 40%, that is not losses unless you pull that money out. That is not losses unless you pull the money out. The pandemic is a great example of this. We knew the pandemic was coming. It was really easy to sell. I saw plenty of people that sold, they cut off their losses at maybe 20%, 15, 20%. They saw the slide coming, they hit sell, sell, sell. They still, got some of the losses a little bit here and there. But then the market hit a bottom that nobody knew about and rocketed out of it. So you missed that rocket because you were out of the market. Okay. So we should have an allocation to the stock portfolio, just like in our working years. Put your blinders on. If the market crashes, it's a buying opportunity. Keep putting money in. Don't let it bother you. You don't need that money. There's your key. If you don't need that part of your portfolio, then it's just turbulence. And that is so important. If we can weather the storm by using other assets to pull from, then it's just turbulence. That is the proper allocation to the stock market. Never pull from losses. Be able to sleep at night. Know that the portion you have in the portfolio, it's just turbulence if you sleep through it, right? You got other places to pull from. You don't need that money right now. Next part, the philosophy on fixed interest rates. Fixed interest rates are CDs, bonds, and fixed annuities. Okay, those are really our main three choices out there to invest in fixed interest rates. Okay, if you want safe investments and you're looking for fixed interest rates, you really have three choices. You go to treasuries too, but bonds, should encompass treasury bonds as well. Okay, so there you go. Now, the philosophy on this is try to lock in higher interest rates for as long as you can. Lock in shorter or lower interest rates for as short as you can. Okay, so that's just a 10,000-foot view philosophy. We look at the last 24 years on this chart here. 24 years on this chart over here. 24 years. You look at these interest rates and the peaks and valleys of it. And I want you to understand that the interest rates where they're at right now, call it around 5.5%. 5.5% is the best interest rate we've seen in 20 years. You have to go back to 2000 before you see interest rates higher than that. Okay, and that was right at about 6%. And we've had chances at 6%. I locked in 6% for 10 years. So there are the chances here and there to pick out one company may offer that 6% out there right now. 5.5%, 6%, the best we've seen in 20 years. So what are you trying to do? You're trying to lock these interest rates in as long as you can, reasonably. Okay, and that's the hard part. Go buy a 30-year bond. I can lock in 5.5 for 30 years. Well, wait a second. Are you going to need that principal, that dollar, within 30 years? If you need some of this money more than just the yield coming off of it, then you're going to have to figure this out, right? And that's where bonds, you want to buy those if you're not planning on selling them. Okay, whereas CDs, well, they're only short term. There's really no good long-term ones, and you don't have access to the money. So we got a problem with those too. And the third choice was those MYGAs, those fixed annuities. Well, they give you access to 10% of the money. So remember, the proper allocation to the stock market means you have to have some place to pull money from. That's why we used to ladder CDs. Well, fixed annuities, now we don't have to ladder those CDs. We can lock in that higher interest rate for, in my case, I did a 10-year. So I locked mine in for 10 years. And I can pull money out if I need to. That's key to this, having a place to pull from when the stock market's not doing well. So very important that we understand the functionality of building a safe investment portfolio based on your needs. Now, if you're fine just using the yield, if you lock in a 30-year bond at 5.5 and you're never going to need the principal, and you're fine collecting the interest or reinvesting it if you didn't need that either, great, wonderful. Bond is an option then. But we've got to understand that functionality. So we try to lock in the interest rates as long as we can when they're high and as short as we can when they're low. We have to do that. The other thing I want you to challenge yourself, because I find this whole investing world a little different than most people do. I want you to look back at your portfolio, and if it were possible, which I know it's probably not, I want you to do a statistically significant analysis, not the last 5 years, not the last 10 years. No, statistically significant is 20 years, okay? If you could actually come up with the annual rate, compound rate of return for your portfolio for the last 20 years, I bet you a 6% fixed rate, especially a compound 6% fixed rate, would have done pretty much the same as what you did. And that's if you efficiently invested in the stock market. If you were inefficient for the last 20 years, the 6% probably would have blown away your stock portfolio. And that scares people. They don't want to do that analysis, but I've seen it over and over and over again. I've compared the S&P 500 to a flat 6% return. It's the break even for an efficient portfolio in most 20-year periods. So really, really an eye opener for a lot of people. You hit that 5.5%, 6%, and boy, that's pretty powerful to have that in your portfolio. So even if you don't need safe investments, it's a good idea to integrate some of that when we have these higher interest rates. All right, next part. Separate and diversify your safe investments. Bonds are not the only safe investment. I'm so tired of this. It makes no sense. I've been screaming it for 20 years, and I'm not joking. I have been. I don't have proof on YouTube. I have proof on YouTube for 2 years, but reality is anybody that knows me, not one of our clients has only had bonds as a safe investment. Makes no sense whatsoever. When we have zero interest rates, you start getting out of bonds. So can you speculatively use them now? Sure, that's fine. But here's what I want you to do, especially if you're either heading towards retirement or in retirement. Okay, money market accounts or funds. You know, if you've got a Schwab account and you got a money market fund paying you 5.5% interest, great, that's wonderful. But that's the shortest of all short-term interest rates. And what did I say about these higher interest rates? Lock them in as long as you can. So the reason we use the money market accounts or money market funds is for money that we plan on spending within 1 year. And then we go to refill it annually, because if you have the right portfolio, you're going to look at it and say, well, the stock market's up, let's pull from the stock investments to refill it every year. If the stock market's down, let's pull from the safe investments if we're going to refill it every year. Okay. So that's why we have this allocation. Now I say separate. Okay. Separate and diversify are two separate things. Think about it like this. I want to have a portfolio of stock market investing and a portfolio of safe investing, instead of one portfolio with stocks and bonds in it. Okay. The reason everybody got tricked was they never actually paid attention to the safe portfolio separate from the stock portfolio. Have separate portfolios. Okay. Build a safe portfolio, build a stock portfolio. You do those separately. Okay. This will help you do this so much more efficiently and actually be able to pay attention to it. So now when we go through all the world of safe investments, individual bonds, okay, we can lock in these interest rates for a longer period of times with individual bonds. But you only utilize these if it's a part of your portfolio where you do want safe investments and you're not going to need the principal, not going to need the actual money. When you buy a 30-year bond, a 20-year bond, a 10-year bond, you have to plan on holding it for that entire period. If interest rates crash and you want to try to speculatively sell it for a profit, great, that's wonderful. But structurally, from a planning standpoint, you're buying individual bonds because you're okay with just the yield and you never plan on touching the principal of that bond. Municipal bonds, well, you use those for the same reason, except now we get to protect ourselves from the taxation. You're going to get a little less interest than you would from the traditional corporate bond, but the municipal bond will shelter the taxation from there. Then you've got fixed indexed annuities, okay? So if you don't know what those are, they're becoming much more popular now because this is a safe investment that has no risk to your principal. It should also have no fees. Very important, okay? So you look at this to replace bond funds. The bond funds are flexible. Some years you earn 4 or 5%, some years you earn 2%, some years you lose money. Well, in a fixed indexed annuity, you can't lose money, but some year you might make 0, some years you might make 5, some years you might make 15. So your earning is flexible and it's paid based on how the stock market does. So this is a fantastic diversification to help us keep up with inflation, because if you only have fixed interest rate investments for your safe investments, what if interest rates jump? What if we have another bout of 9% inflation and they push interest rates to 8%? Okay. You don't want to be stuck at 5, 6% if interest rates are 8, 9%. And that is why adding the flexible safe investments will help us keep up with inflation. So just having fixed interest rates, not a good idea. Okay. Limit the amount of fixed interest rates and add some of these fixed indexed interest rates in there. You can't get hurt if interest rates rise or fall. You get paid more when the stock market goes up. You get paid less or nothing, but don't lose anything when the stock market goes down. That's the core competency of these fixed indexed annuities. It's a great diversification in a safe portfolio to help us protect from higher interest rates and inflation. Again, we're building a safe portfolio, not just investing in bond mutual funds. Next, fixed and fixed indexed annuities when access is required. When you look at all the choices of safe investments, we've got to look at these reasonably because fixed and fixed indexed annuities give you access to 10% of the money every year. So if you functionally need to be able to pull like a required distribution out or something like that, then these are going to be much more friendly for you because you don't have to sell the investment. You get to keep your interest rate and pull some of the money out. You don't have to break the CD and sell the whole CD and then find new interest rates. So when interest rates go down, you still get to keep that high interest rate. That is a huge core competency, and that's why these have become so popular over the last few years because they are just that much better than our other choices of safe investments. We use bond funds because we were getting paid yield and they were growing in value as interest rates were going down, and they were liquid on top of that. You just hit sell and you made money. Woohoo, everything was wonderful. Yeah, but that's not how things work forever. That only works that way if interest rates keep coming down. And we've now realized that that doesn't happen. That happened for 30 years. It doesn't mean it's going to continue happening into the future. So we have to have other investments that we have access to. And that's why now the fixed and fixed indexed annuities are becoming so popular because they are a safe investment that gives you reasonable rate of return with no risk and no fees, and you have access to it. It's what you thought those bond funds were, okay? So now the next one is bond funds only to speculate if you think interest rates are going to lower. This is now not a blanket safe investment. The only reason you're going to use a bond mutual fund is you're going to buy it speculating interest rates going down, and then the other key is selling it. You're basically timing the market. You know, you hear that, but it always relates to stocks. I'm going to buy it low and sell it high. That's great. That always sounds wonderful. Well, you can do the same thing except with a bond fund, and you're watching interest rates. Okay, so you buy one now, you wait for interest rates to fall, and then you sell it and you make a nice little profit. You just have to remember to sell it. These bond funds are not your blanket safe investment anymore. You can lose money. Interest rates come down, they go back up, you made nothing. Okay. And then the last one is the fixed annuities, MYGAs, multi-year guarantee annuities. They've rendered CDs useless. They literally have. There's no reason to own a CD. Remember, interest rates are higher. You want to lock them in as long as possible. Go find me a 5-year or more CD that isn't callable, that's paying a reasonable rate of return and compound. It's not. Good luck. Have fun finding it. A lot of those CDs, you go past 1 year, you're going to find out in the fine print that they are callable and or that they're not compound interest. And you get to 5 years without compound interest, there's no reason to buy that investment whatsoever, because these fixed annuities, the core competency of these is 5 years, 6, 7, 8, 9, 10 years. That's the anywhere between 5 and 10 years is where you're going to see these things really shine. They're almost all compound interest. Okay, compound daily, earning interest upon interest, and they give you access to the money along the way. These are just better than CDs. I don't know why anybody utilizes CDs. And sometimes the banks go through periods where they end up selling you these MYGAs, multi-year guarantee annuities, because these are literally just CDs from insurance companies. And sometimes the banks, the CDs aren't profitable enough, the numbers aren't working, and so they switch to start selling those. So these have been the most popular investment over the last safe investment over the last couple of years. We're talking 300 billion a year going into these things. It's insane how much money is shifting into these things because people are finally opening their eyes and realizing it. So part of being unbiased is get rid of all that stigma that you hear. Oh, I hate the word annuity. You got to get past that. That world has changed. Investing changes. Just because bonds worked for 30 years doesn't mean they are going to continue to work. That's ridiculousness. That's not how you manage investments. We have to know that the investing world evolves. Okay. Just because there's a dirty salesman that sells you an annuity that didn't fit you doesn't mean all annuities are bad. Just because I owned Enron stock once doesn't mean all stocks are bad, right? We got to understand that. So be careful about the stigma that's out there and build a reasonable, safe portfolio separate from your stock portfolio. So you're actually paying attention. And this is going to help you shirk that stigma of the baby boomers not knowing how to handle inflation, because the study was pretty convincing that all the baby boomers screwed up when it came to addressing inflation in their portfolio. And I think that is more the advisor's fault, because a lot of the baby boomers that have money use advisors, and the advisory world, they make money off bonds. They make a lot more money off bonds than they do those annuities. Trust me. So we got to get rid of that stigma, and we got to fix these portfolios. So those are the 3 steps. Those are the 3 key things that you got to think about as you go through and adjust your portfolio for inflation protection. All right. I hope that helps. I love this stuff, this whole investing world, especially as people head off into retirement. It's my favorite phase of life. Coaching people in that within 5 years of retirement and coming up with a plan to get you there and get you successfully funding and enjoying your retirement is the best thing I could say I could ever do. So if I can help in any way, your investment counselor, you can always book a 30-minute free meet and greet or an hourly appointment, whatever you'd like. I'm always happy to help out. And yes, you do actually meet with me. I'm not just some marketing ploy. And then full classes, if you haven't experienced our full classes, fpfeaz.org. I do them live over Zoom 2, 3, 4 times every month. And certainly give us a call if you need anything. Go explore our channel. There's hundreds of videos, couple hundred videos on there. We got almost 10,000 subscribers. So if you're not a subscriber, please do. I add a video every single week. All right, everybody, have a great one. See you next week.